Hi. Hello, everybody. Thank you for staying with us in this audio maxi room. Now we will have the third panel of the day. There will be just one other panel after us. So this morning we had the yield panel. You just had the chance to have the crypto VC panel, and now we will talk together about two of the most growing markets that we decided to combine in the same panel, DeFi and crypto derivatives. So we have 1 hour together, yeah, we'll also appreciate if you have any question. We'll keep sometimes at the end to get questions from the audience. Yeah, let's start. So maybe we start with a presentation. I will start. My name is Jérôme. I've been in the space for since 2018, involved also with the Crypto Valley for the last 5 years, and now I'm a board member and vice president of the association, and I'm also working for Adnovum, which is an engineering and cybersecurity company for fintech and banking, based in Zurich, Bern, and Lausanne, where I'm based. So I'm more from the French-speaking area of Switzerland. And yeah, today I have the chance to have 4 amazing panelists. So let's start with you, Noelle. Can you say a few words about you?
Yes, good afternoon, everyone. My name is Noelle Acheson. I'm head of market insights at Genesis Trading, which is the market's leading digital asset prime broker. We're the largest crypto lender for institutions in the space. They've been doing OTC since 2013, and also derivatives and custody. I got into this space in 2014. I've been researching it from a markets perspective since then, because I'm a total capital markets nerd. Before joining Genesis a year ago, I was head of research at CoinDesk, and I've always tried to look at the space through the institutional lens, because as I'm sure we'll get into, the institutional liquidity is part of what gives the markets validity, which funnels funding. Nothing I say is investment advice, obviously, and these are my opinions, not those of my employer. And I feel very privileged to be here with all of you today. I've learned so much since I got here yesterday. Genesis, I should say, is based in New York. We also have teams in London and Singapore. I came from Spain, though, where I am very grateful to be able to live.
Thank you, Noelle. Esty?
Hi, I'm Esty Dwek. I'm Chief Investment Officer at Flowbank. We are a relatively new bank, so fully licensed, FINMA-regulated Swiss bank, 100% digital with a broad and growing crypto offering. But I think, as we'll discuss later, it's quite nice to have the ability to do your crypto and your non-crypto in one place. So I'm very excited to be here, joining all the crypto experts, which I am trying to become, and I look forward to the discussion.
Hi guys, my name is Piers Ridyard. I am the CEO of RDX Works, which is a core developer of the decentralized finance protocol Radix, which is a public ledger entirely dedicated to decentralized finance. Radix actually started as a research development project back in 2013 into large-scale decentralized public ledger scalability. But in 2019, we realized that the main constraint of the market actually wasn't scalability. Everyone says it is, but if you look at the numbers, in the last 2 years, capital has 220x'd in the space, but developers have only 2x'd. There are 18,500 DeFi developers currently developing today, which makes one developer worth $11.5 million in total value locked, which tells you why an average developer salary is between 200 and 300,000 in the space. We realized that's the major constraint, so what we did is we created an incredibly easy way to build DeFi by following what the games industry did back in the 1990s by creating a DeFi engine that gives you all of the fundamental low-level difficult things like safe asset transfers, like asset swapping and things like that, and put it into a really elegant language called Scripto, which makes it incredibly easy to build decentralized finance to address actually what the key concern of the DeFi market is, which is talent.
Hi everyone, my name is Patrick. I'm the head business development at Bittrex Global. Bittrex Global is an OG cryptocurrency exchange founded back in 2014 in the US. because of regulations, we had then to split the exchange into two parts, basically. So we have the US exchange on the one end, and then we have the global exchange. That's where I'm employed. And yeah, we are very happy to be here because we are the only regulated exchange in Crypto Valley. So we have our headquarters in Liechtenstein, Vaduz, where we are regulated as a cryptocurrency exchange, a token issuer, and a token custodian. And then we have as well a license in the Bermuda, in Hamilton. And yeah, our platform is here since 2014. We have never been hacked, so you can really trade in a secure way on our platform. Yeah, so happy to be here and to contribute to this panel today.
Thank you, everybody. So let's kick off now, and we'll start with DeFi, and we'll start with Piers because you are our DeFi specialist today. So I want to start with a provocative question. So what we lived in the last few weeks and months, we've seen some DeFi hacks, we've seen some yield Ponzi, of course, Terra Luna. So my question for you is that, has DeFi failed?
Yeah, it's a great question. So like, I think that right now, the view of the market is we have to take a view on what went wrong with things like Terra Luna. Why was that risk able to get so out of control? We have to take a view on what it is that we're building these marketplaces for. Like what DeFi, like one of my friends said to me a while ago, he said, DeFi just feels like it's building marketplaces for three-legged donkeys. Like nothing in it is actually like interesting. It's just lots and lots of like speculation and often Ponzi's. The thing is that what DeFi is doing is creating incredibly efficient markets for three-legged donkeys. And why that's really interesting is because when you start applying that to real assets, if you look at the capital markets, a lot of people will say that the capital markets are very liquid. They're not. Actually, you have a small percentage of the market that is very liquid, the high-capped stocks, the large bonds, and then you have this very long tail of massive illiquidity. And then what DeFi has done is shown us how it's possible to create bootstrap liquidity, how it's possible to create communities that have a vested interest in making sure that those tokens are tradable. And when you can start applying that to more asset classes that people care about, like stocks and shares, like derivatives that are derivative instruments of stuff that matters, like FX and stuff like that, when you can start to apply that to bringing real-world assets onto Ledger and take all of that learning that's happening within DeFi, you start to see how DeFi could actually be some of the most effective ways of creating capital markets in real assets, as well as what has currently been a lot of playing around with technology. But that's good, because that ability to play in that permissionless sort of like cowboy environment means that you can fail fast, that you can quickly iterate. And so what we're seeing has been a huge amount of innovation that has come out of this. And I think one of the things that, and the reason that I think these two things go together is derivatives are going to be a really important part of this as well. They're going to be a really important part of the risk management process for DeFi that just hasn't been there before, that will start to become more and more important in making these markets feel more mature as well. So no, it's not dead.
Actually, I have something I'd like to add to that, okay? I'm following what Piers says, the fail fast thing. What DeFi is, and even legacy banks will tell you the same, what it is colossal experimentation at scale with real-world economic incentives. One, we've never been able to do that before with any of the technologies that we had up until the blockchain. And two, of course, experimentation is going to fail. That's why it's called experimentation. It's supposed to fail. I would actually argue that in spite of the turmoil that we had a couple of weeks ago, in fact, because of the turmoil that we had a couple of weeks ago, DeFi is succeeding. One, it is weeding out the ideas that don't work. Well, the previous panel talked about skeuomorphism. We now know more than we used to. We can continue to build. But two, DeFi actually worked. There were a couple of isolated, spectacular failures, but everything else worked really well under great market stress, arguably record market stress. DAI didn't really depeg very much. Curve continued to do what it was supposed to do. So I would say that with the mother of all market stresses on the table, DeFi succeeded.
And so what's next? What's next for DeFi? What needs to be improved? What's next? And I don't know, maybe Piers?
Yeah, so I think that the next phase is going to be split into two parts. I think one part is going to be more regulated assets will appear on DeFi on top of public ledgers. So like I don't see regulated perimeters as being the opposite of what DeFi is. So for me, DeFi is financial applications built on top of public infrastructure. The public infrastructure being decentralized is immensely important because if you're going to build a global financial system, you want the infrastructure that's built on it to be supranational and super corporate. You don't want it to be able to fail as a result of a single nation or a single company. So that's why it's a really good place to build it. The other thing that you get is that if you choose to build on a public ledger, you're suddenly instantly compatible with everything else that's built on top of that ledger. You don't have to have, sort of the long application process that you would have to do if you wanted to build something against the London Stock Exchange, because you don't have to get access to the APIs and all that kind of stuff. If you build an application on top of a public ledger, it's now instantly interoperable with all those other applications and the assets that are within them. But there is KYC, AML, and all that kind of stuff that's necessary to be able to bring things like stocks and shares, to be able to bring things like property, to be able to things that look like securities. But what's already happening with things like Aave Pro is going, well, what if we gate access to these DeFi apps? But what if we have several apps within that garden? So I think that what you're going to start to see is what looks a little bit like various access levels on public decentralized ledgers that allow you to have regulated assets in there that can get all of the benefit of community-provided liquidity, community-provided trading volume, all of this kind of stuff that is really great, but you can start to also bring some serious asset classes into the space, because ultimately the capital markets are increasingly starved of yield, and this ability to be able to find more yield by creating better, less intermediated financial products is going to continue to attract larger and larger amounts of capital into the space as long as those things can be solved. And then on the other side, I think derivatives is the number one thing that's going to be huge, because Terra Luna, what would happen if Terra Luna had been able to buy a short on itself? Like, what if that had been possible, right? Because it was growing so much, it could have sold a long and bought a short to fund its position, and then if the market had collapsed, it would then have been fully hedged. So things like that mean that you can start to manage the volatility risk that just wasn't possible before. So that's why I think derivatives is going to be huge.
Yeah, perfect transition. Before going diver in the derivatives, I just want to also position it and ask a question for you, Esty, to explain to our audience what really are crypto derivatives and why do you think they are important on the market?
Sure. Well, I think you just gave a very good example of how they can be useful. The way we look at it mainly is through contracts for difference, so CFDs, which allows you to gain exposure to any asset, including obviously crypto, without having to own it. You can go long or you can go short, so you can have either view that you want, and you can be leveraged, so you can enhance whichever play you're trying to make. In terms of the uses, I mean, that's, I'd say, one very specific example that feels like it would have been unlikely, even if it was more possible. I don't think the market was thinking that way before the crash. And I think even discussing what you both mentioned before, there probably needed to be a little bit of weeding out and calming and cooling of the market in general. But there are a couple things to keep in mind. The first is hedging. So that was one example. But of course, if you're worried about your positions, if you want to just have some crypto exposure as a hedge, but, and no offense to all the crypto experts, have to deal with getting your wallet and getting everything set up, you can have that exposure either long or short. So it can hedge either your long exposures that you already have, or it can hedge other parts of your portfolio with some crypto exposure. The other thing is, and this was mentioned in the panel before about the level of, or maybe even before, about the level of volatility of the crypto market. And it's true that people keep saying crypto is volatile, crypto is volatile. And if you look over the last few years and the peaks and the troughs, and of course when you drop more than 50%, you can't call that not volatile. But if you just look at the last couple of months, now for those who were hoping to go back to the November peaks very quickly, it didn't happen, but you did have some form of stabilization come into the crypto market. You look at, you said it was a success because so many things held up. You look at Bitcoin, you look at Ethereum, they held up relatively well given the whole Terra situation. So the volatility has come down a little bit. Now, if we bring this back to derivatives, when you're in that type of market where not that much is happening, and we've really been in a broad trading range for a number of months now, the derivatives allow you to make money within that trading range. You don't have to always be long. You don't have to go out and buy and wait until the market recovers, which I'm assuming everyone in this room believes it will. You can take advantage of this type of situation. You can play different headlines, whether it was the jobs market half an hour ago, whether it be the Fed meeting in a couple of weeks. You know that some of these are going to be triggers for the market, and the derivatives market will allow you to be very specific and very short term, but take advantage of the trading range rather than sort of suffering through it until the market does better.
Thank you. And now I want to connect that with institutional and to you, Patrick, because your main clients are institutional. So why are crypto derivatives needed by these institutional investors?
Exactly. I think Esty touched a lot of point there, right? The main goal for institutionals, I think, is hedging their positions, right? If this is an asset manager, if this is a hedge fund, they have certain exposure, and they want to make sure that they can somehow limit the downside, right, and protect what they are having. So if we take a step back, for example, and look at how the derivatives market in crypto developed so far, we saw that most of the volume was driven by retail. So with all these perps, right? So they were betting on price moves. They wanted to leverage their positions to make money, to make fast money. And now with institutionals coming in, you see the shift from perpetuals more towards more sophisticated derivatives like options or futures. Futures, you trade them, for example, at CME, or as well options, you have different platforms. But the problem there is, and this is as well the thing, that the correlation no longer is close to 1, let's say, within crypto, is we only have options on Bitcoin, on Ethereum, and I think since a few weeks we have Solana as well. But these are just free assets, and we have thousands of assets, and you cannot properly hedge them. So what can you do? You can just do a proxy hedge, but that wouldn't have worked for Luna, right? So you cannot hedge your possession with BTC proxy hedge for Luna. So there is definitely a need there that we need to ramp up the offering there to make sure that institutionals can come in and properly hedge their position.
Yes?
I think one of the things that with derivatives, and I didn't say this before, but there still needs to be a piece of innovation that hasn't happened yet. So if you look at what happened in DeFi, one of the key things that pushed decentralized finance forwards was the emergence of decentralized exchanges. And the Uniswap and the Bancor models of constant function market makers was critical, because what it did is it said, look, this is how you can create a virtual order book for 2 assets, but on a constant curve. So you don't have to have sophisticated market makers to be able to make both sides. You can just put some assets in, and we will create a market that will get deeper as more liquidity comes into it. What is currently happening in derivatives still is the traditional way of creating them, right? So a lot of if you're creating an option, you'll be using the Black-Scholes-Merton model, and you will be doing them as an individual priced asset. You'll be going, okay, you need this much on this date. I will price you now, and I will decide from my book of assets how much risk I'm willing to take on that option, right? I think that there's something that needs to happen. I don't know what is going to happen in the next 6 to 12 months, but I see some projects like Potion Finance and stuff like that are starting to understand that it is possible to create some kind of automated pricing for long-dated options where you can do the same thing. A community can come along, create liquidity for something, and enable the emergence of a market price dynamic between buyers and sellers that create the pricing as a result of their interactions, which is what's happening with things like Uniswap. That still needs to happen for derivatives on top of public ledgers to work properly. And until that happens, most of it's going to happen on exchanges. And I don't know exactly what it's going to look like, but then that will solve the problem. Because the whole point of things like decentralized exchanges like Uniswap and like Bancor is it enable communities to go, this is a long tail asset, but we want it to be liquid. Same thing's going to happen with options and derivatives. They're going to go, this is a long tail asset, but we want it to be possible for there to be hedging on it. So we as a community will work out how much capital we're willing to put into that to make sure that's possible. And I think teams will also start to incentivize that for happening because they understand how important hedging is for, for example, foundations and the tokens that they have or whatever it happens to be. There's lots and lots of risk that DeFi projects and companies that are funded by tokens are taking constantly of their own treasury. Like companies fail as a result of bear markets just because of that. So I think that idea of incentivizing your community to help you create hedging products as there was in this first phase of DeFi, incentivizing your community to help create liquidity, that's going to emerge as a big trend in the next sort of year or so.
I have a couple of quick things to add on to that. One, the access to derivatives does very much depend on regulatory structures, and that still is lamentably very fragmented around the world. At Genesis, for instance, we can deal in a very wide range of derivatives, including some of the ones mentioned because of our regulatory structure. So it's not as liquid as it could be, but it certainly is liquid enough for the institutions on most of the large cap assets and even going down to some of the lower ones. Two use cases for derivatives, which is, again, bringing back to the institutional side that I find particularly intriguing. One is, at Genesis, we've seen a lot of funds recently take out short positions on Tether. Now, this is taking out short positions on a stable coin, which is not very intuitive. But one, we all know that there are many people who have a bearish view on Tether that are concerned about its stability. And even if you're not concerned about its stability, a short on Tether is a hedge against the entire market. If Tether depegs, the market is in serious trouble, so you can recoup some of your losses there. But putting my analyst hat on for a second, what I most enjoy about the derivatives markets, I don't participate myself, but it's the sentiment data. When you have a liquid and reliable idea of the average mood through skew, through the funding rates, through all sorts of products that you don't get in the spot markets, then that just adds to the richness of the information and insight that we can get into a market that we couldn't get without that liquid derivatives.
I've heard my favorite word of the last few weeks is correlation. I think you were talking about correlation. So maybe for you, Esty, what do you think about correlation? Is it transitory, to take this word, or what's your view on this correlation between crypto and traditional market?
Well, actually, Noelle and I were talking about it just before the panel. It's been I think it's been one of the big generalizations that non-crypto people have used, I'd say, against crypto, is the rise in the correlation of crypto with risk assets in general, with US equities in particular, and of course with the NASDAQ at the top. At the peak, we were at 0.8, 0.9 correlation. So whatever US tech did, crypto did, and it was still that way. It was still tech leading the way, not tech following. Now, it seems to have been starting to come down more recently, in part because tech has actually started to rebound, despite a lot of people not noticing because it's been pretty painful in markets, but tech has started to outperform and to rebound a bit. And with, I'd say, some of the fallout from the Terra Luna situation, we're still not seeing so much recovery across a number of the crypto assets. But if you take a step back, crypto in general is still a young asset class. We have a lot of experts over the last 2 days who've been involved since, I think 2012 is maybe one of the earliest dates I've heard, very often maybe 2017, 2018. But most people got in a lot later. So the majority of the people, first of all, they got in at the wrong time, but maybe that's a different conversation, although hedging certainly could have helped some of those investors that started coming into crypto during COVID. you can't generalize a 6-month correlation to tech stocks on an asset class that has only become broad and I'd say with some generalized adoption, because we're still in the early stages, so soon. We know there have been a number of Bitcoin cycles. We know there have been reactions to some of the halvings. At the moment, and recently, there's been a reaction like US tech, probably a little bit of a bubble at the end of last year, definitely fears about liquidity withdrawal, and certainly in both cases, a little bit of this deflation after all of the COVID boom, I'd say, whether that was because people sat at home, got stimulus checks, everyone's decided that trading is trendy, and people got into it. So you can't make that. I think we've been in somewhat not normal market conditions, traditional and crypto, for the last couple of years. Correlation hurt maybe crypto for a little while. I think if it stays a little bit high, it'll probably be a positive for crypto over the second half of the year. We're going to start to see improvements there. And I think if the correlation comes down, and I think it will at some point over time, I don't think this is a set correlation, then we're going to see the asset class develop on its own a lot better, and it'll be one period of time. Before I hand over, I'm sure others have their thoughts. For the last couple of months, you've had a very high correlation between stocks and bonds, which are normally inversely correlated. And finally, a couple of weeks ago, that started to stop. So those periods of positive correlation are short. No one's questioning, well, some I'm sure are, but few are questioning the utility potentially of having bonds to hedge some of your equity portfolio. I think at some point we're going to get to that conversation, that crypto isn't automatically correlated with your equities, and it does have a diversifier property for your portfolio.
Anybody else want to add?
Yeah, I think if you look at correlation, there are certain factors you need to consider, right? Especially in a downturn, correlation tends to be, or gets closer to 1. So we had that in the last couple of months, if not years, if we include COVID. So I think this is one factor. So let's see what's going to happen if the market turns around. But when is the market going to turn around? We don't know. We are all expecting some sort of recession. So let's see what's going to happen. Maybe once we get in a more positive scenario, we will probably see a decoupling of correlation. And I think another factor we need to consider is the correlation was very low between crypto and traditional assets, in my opinion as well, because in crypto for a long time you just had retail customers and no institutionals. And now with more institutionals coming into the space, correlation went closer to 1, right? And I think it's hard to say what's really driving the correlation at the moment, so we really need to consider a few factors there.
But do we want correlation or not? Because I remember, it depends on your point of view. But
it depends on how you look at crypto, right? Yeah. I'm crypto native, so for me crypto is everything. Yeah. But if you look at traditional players, asset managers, they look at crypto as an alternative investment, right? So they're probably just going to invest, like, if it comes high, 5% of their portfolio into crypto, and what they are looking for is a low correlation, right? They don't want correlation to be at 1, obviously, because alternative investments are there to, spice up the portfolio somehow. So I think it really depends through what lens you're looking at it.
So I think that like measuring the correlation of the entire crypto market against measuring the correlation against the entire tech market probably loses the point somewhat. Like, there are certain assets within crypto that we believe should be low correlation, like Bitcoin should be, if it is the promise that it says it is of digital gold, should be low correlation with, or at least inversely correlated with the tech market or with the financial markets, where people are looking for safe places to put their money during areas of market uncertainty. You should expect it to go the other way. The thing is it's still a risk on asset. But long term, I think that if Bitcoin continues to fulfill its promise, it should start to look more and more like gold. But if you're looking at the rest of the crypto market itself, like if you think about the majority of the assets that are being used today are within DeFi, within decentralized finance. And the purpose of the global capital markets as a whole is one thing, really. It's efficient allocation of capital. And what is happening when you have an entire platform that is trying to make it more efficient and programmatic to allocate capital during a period where the global market is pulling back and going, woo, it's a little bit worrying at the moment, so we're just going to pull our capital out, is you're just seeing a reflection of the desires of the investors that are being reflected in the value of the platforms, because it is just an allocation of capital tool, right? So if you as an investor are going, I'm not feeling very bullish, I'm going to pull out of my yield farming, I'm going to pull out of this governance token or whatever, it is just reflective of the global sentiment, because that's what this tool is being made to do. It's being made to facilitate capital allocation. So you can separate some assets and go, these are probably hedges, like Bitcoin, in time. And then other assets is just the global economy. And it's not really, it's correlated because that's what it is.
And Piers has touched on an interesting battle that we're seeing play out in crypto markets. Macro allocators look for low correlation because they want the diversification. And we know that the crypto market is generally pretty highly correlated, largely because of the massive weight of Bitcoin and Ethereum. But there are narratives going down the cap table. There are narratives that are totally different to Bitcoin and Ethereum. There are opportunities that any investor, were they take the time to look into them, would find completely off of the scale when it comes to, does this fit into the rest of the portfolio? And the more investors start to look for low correlations, the more they are going to realize that they're going to find it lower down the market caps. And that is going to bring funding to some of the lesser capitalized assets, increase their market, increase the liquidity, increase the interest in derivatives, increase the sophistication of the market as a whole, which is a net positive, both for the crypto native investors as well as the macro investors looking for that diversification opportunity.
Well, I was going to say, it feels almost a bit like a double-edged sword, right? You want mass adoption, you want people to buy into blockchain, into crypto, you want more and more people to have it, but with that probably brings somewhat higher correlation. And I agree, it might not be across the market equally. And I think, again, the events of the last few weeks are starting to show more divergence and more differentiation between different cryptocurrencies. But if you have more and more people in traditional markets or in traditional portfolios adding cryptocurrencies, it is going to increase your correlation. So it's kind of either a win-win or a lose-lose, but it's that double-edged sword that I think the crypto universe is navigating in general.
Noelle, we had a very interesting talk before on Bitcoin that is especially close to my heart. And can you say a few words about the current Bitcoin market dominance and its impact on this market right now? Can we do a Bitcoin moment right now?
Bitcoin moment, everyone. Actually, it's super interesting because just earlier today, Bitcoin's dominance broke through 47% of the market for the first time since October 2021. The last time it broke through this level was during the whole excitement about the Bitcoin-based ETF in New York, where Bitcoin was massively outperforming. It was a strong market then. The time before that the dominance broke through 47 was July 2021, which was a pretty bad market, arguably very close to the local low at the time. Does that mean we're near a local low again? Don't know, not necessarily. Nothing I say is investment advice. But here's the interesting thing. Why is Bitcoin's dominance increasing in a bad market? Because we at Genesis are seeing a lot of funds rotate out of the more volatile assets, the alts we call them, into the huge air quotes here, the safe asset of Bitcoin. Now, obviously, Bitcoin's not safe, and nothing I say is investment advice, once again. But relatively speaking, it is the blue chip of the market, and a lot of investors see it as the safe option within this risky paradigm. So that is why, that's the story that you get from this fascinating metric of Bitcoin dominance. Now, here's another thing. It is going to increase the opportunities further down because they are largely right now being overlooked, and depending on your investment thesis, could possibly oversold. I won't repeat about the whole thing about not being investment advice, you know the drill. But that's why the market right now is especially fascinating. It's a fairly bleak market in terms of sentiment, including from derivatives data, we're seeing that too. But Bitcoin's role is obviously being de-risked from many of the macro portfolios because of the high correlation. They're just de-risking anything that has a high volatility. But at the same time, it is gaining in prominence in its role in many crypto diversified portfolios.
Yeah, I think as well. If you look at the cycles, because you normally have these kind of cycles in the crypto markets, right? So if the market pumps, normally first it's Bitcoin who pumps, then you have ETH, and then you have all the alts coming later. Same thing happens when there is a crash, right? So first Bitcoin goes down, and then the rest goes down. And when the rest goes down, you normally see the shift from altcoins into Bitcoin, right? So I think this is quite interesting as well in crypto. It was a bit more dominant, I would say, a few years back. It came a bit back, but it's still there. The pattern is still there.
Okay, thank you. And let's stay with you, Patrick, and come back to Switzerland because it's our country. You explained to me how important our derivatives market for Switzerland. Can you tell us exactly what is the position of Switzerland in the crypto derivative market?
Sure. So maybe a little background. So I was working in derivatives here in Switzerland at a major bank in traditional finance. And given that background, I was working in structured products, and Switzerland is probably one of the biggest markets in structured products globally. Huge volumes are in there. I was working in equity derivatives, and if you look at structured products in particular, I mean, like, Noelle, you probably know better because you guys take the risk and you structure that kind of thing. But if you look at these kind of products, it's very interesting because you get more and more demand from customers now. I'm talking about dual currency swaps, I'm talking about capital protection notes or yield enhancement products. And if you look at the volatility we are having, especially for yield enhancement products where you are going short a put, for example, that just creates a very attractive yield for investors. Obviously, you have to consider the risk as well, but that's crazy if you compare it to all the other asset classes. So if you take crypto as an underlying to structure a nice product with a customizable payoff, that can add a huge benefit to your portfolio.
And can we compare Switzerland versus Europe, maybe?
Well, I'm not very sure about crypto, how it's evolving in terms of structured product. I think Switzerland is still very strong. Obviously, we have a lot of flow in Europe as well. But I think what is going to be crucial for the market and as well for Switzerland is how we are going to regulate that. And once we have proper regulation in place, I hope we will see more and more inflows there as well from traditional players.
Okay, excellent. So maybe, Noelle, what, for your point of view, why do you think the market is safer thanks to the derivative? And is it now the good time for the institution to come back on the market after what we experienced?
I think it depends what you mean by safe, and I think if what you really want is safe, crypto is probably not the right venue for you to be investing in. So, but safe being a relative word, as we were talking about before, it is true that two things. One, derivatives do make it more liquid, make it easier to present an opinion, make it easier to take a long position that you can hedge. A more mature market is safer than a less mature market. Again, safe being a relative word here. When it comes down to, again, safety though, I think what we're talking about is the assurance that you might lose money, but that's investing for you, there's no return without risk, that you're not going to get in a huge amount of trouble, that you're not going to be dealing in anything illegal. No fund, no institutional investor wants to even go close to anything like that, the reputational risk. And over the past few years, and I've been covering this market now since 2015, over the past few years, that is the biggest change. It's the reduction in regulatory risk. I mean, 4 years ago, there was a chance this could have been banned. Some politicians were talking about it. That's pretty much off the table now. And the caliber of the institutional investors that are focusing on this space now, and the number of legacy banks that are building teams and developing projects, not to mention entire subsidiaries for this, that's taking the regulatory risk off the table. And I think that is the main thing that the institutions are worried about. They don't think of crypto as a safe space. They think of it as a potentially high return space. What they want to be sure of is that it is regulatorily relatively safe. And obviously there's still a lot of work to be done, as we've seen over the past few weeks. But the change over the past few years, I would say, has been one of the most astonishing. The fact that we had an executive order come down from the highest office in the land that regulates the largest capital markets in the world that was supportive of the space, I think is also one of the most astonishing things to happen this year so far.
Mm. So we talk quite a lot about the role, the hedging role of the derivative, but we didn't talk too much about leveraging. Anybody want to talk about the extreme leverage that we've seen on the market and what impact could have been of, well, I don't know, 100x leverage we've seen on some platform, not yours, but anybody want to talk about it this point?
I can take a stab at that. I think again you have to keep in mind of what investors you're referring to, and of course I think the institutional space is going to be much more cautious and much more structured in the way it invests. But if you think back to the last couple of years, you had this confluence of events that led to a lot more people looking at the space and investing in the space. And then you heard more and more stories about all these people getting so rich with their Bitcoin. And you had people stuck at home, you had people who didn't want to go back to certain service jobs and were still seeing the consequences of that. And you had people who thought, I want to join the party. And at some point, greed took over a little bit. It's often the retail investors that want to do that even quicker. It's often the retail investors that come in a little late to the party, and they're the ones who suffered the most in the last 6 months from the deflation of the whole asset class, not just in crypto. And they're often the ones who probably don't understand exactly what leverage entails. I think they see the upside a lot more than the downside. We see it very often with clients. We've done training with some clients and some colleagues recently, and most of it was about explaining like a stop loss or a margin call or what happens when things go wrong. And we got to a point where the market was going up so much and so fast that I remember last year everyone was waiting for 100,000 on Bitcoin. Some people have a few more zeros behind that, but not with a 6-month horizon. And people thought, oh, is 48,000 a good resistance to dive in because I missed the last little bit, or just compared to where we were a year before that. So you need to have a little bit of education of the universe in general, and again, this isn't just for crypto, this is for leverage in general. Because I think the people who took some of the more extreme leverage were the people who were newer to the asset classes and really just only saw how high it could possibly go. So I think that's where you have to be a little cautious. And that's why I think on this panel we've been talking more about the hedging properties, maybe about taking advantage of a trading range, and not necessarily talking about derivatives as this way of boosting your returns very quickly.
I think one of the brilliant things that has been happening in DeFi is we're seeing basically the last 100 years of financial market learnings being replayed very quickly. This particular phase, let's call it, leverage isn't always good. The thing that I think was spectacular about this particular deleveraging that happened and the cascading liquidations and all that kind of stuff. And I haven't actually seen anyone, like, it literally just occurred to me now, I haven't seen anyone comment on it, but the fact that it's instant settlement, I think, was one of the most important characteristics of it not actually leading to catastrophic failure. Like, so what you saw in the banking system, in the deleveraging that happened in the banking system, it was the overnight lending rate that killed banks because settlement was T+1 or T+3 or T+5. And being able to create smart contracts there, instant settlement, collateralized instant settlement, has meant that the deleveraging process, though it was very painful, actually didn't create a fundamental killing of a DeFi application like DAI. You were talking about DAI. DAI is a great example, and MakerDAO, and like Aave, and all of these kind of things. So that lack of settlement period means that there was this extra learning that happened. But yeah, I think that leverage has its place, and I think that crypto has learned a lesson this time, and we'll see how it sort of goes through to the next one, especially when more hedging. I'm going to keep talking about hedging products, but when more hedging products come out as well to help take the other side risk of that, and people thinking about market neutral strategies more than just pure risk on strategies, as well as thinking more about stop losses or like buying put options and stuff like that. And I think that's going to come in more. And when you combine that with leverage, that's going to create its own set of problems. But it's really interesting.
It also comes down to the volatility that we were talking about earlier. Volatility has come down recently, largely because investors actually don't know which way the market's going, so we're not going to bother to move it one way or the other. But options, derivatives, are a bet on future volatility. So if you think the volatility is going to increase, who here thinks markets are going to get more volatile over the next few months, then that makes derivatives a very intriguing possibility, which will bring more liquidity into the derivatives, which will deepen the market sophistication, et cetera, et cetera.
All right, thank you. So we are approaching the end of our panel. We have a few more minutes to take some questions from the audience. So feel free to ask your question. Anybody to our panelists? Is there somebody? No question? Yeah, come on. You can do it. The first question? No? Okay, so I will. Ah, yes, thank you. Can you repeat the question?
So I think the question was if the product range in derivatives is going to increase if we see more risk, right, basically in the market somehow. So what I think is if we are going to implement more products, does not necessarily mean the risk is going to increase, because for me the more innovation in derivatives makes the market more mature. So you can have proper risk management on your assets. So in that sense, I think it's going to be great, but we need to be careful how we are going to regulate it, right? Because if we are going to make them public or accessible for all traders, we are going to have a problem, obviously. So we really need to have a proper regulatory framework to especially protect retail customers here.
The only thing I wanted to add is, I think at the moment we've had such a hit to sentiment about crypto in general. I've even been surprised somewhat, speaking to people over the last few days, that you didn't have that exuberance of probably 6 months ago. So I think that if you add products as the universe is growing, today at least, speculation is probably not top of the list, because there's not so much confidence. You were saying people don't really know where we're going. Have we hit a bottom or not? So it can happen. Investors have very short memories. It can happen 6 or 12 months from now if suddenly cryptos and other assets recover faster than we think. But it doesn't automatically lead to much more speculative excess. Definitely in the current environment where there's so much doubt about how quickly cryptos can recover.
And to add a bit onto that, I'm going to suggest we step back into the distant mists of time and look at the origins of the crypto market. It's the only liquid market that we have today that sprung up from the ground up, retail first, spontaneously around the world with no coordinated regulation, no coordinated technology. They didn't even know what the others were doing, basically. So crypto is arguably the only truly free market in a liquid state that we have seen in history that I know of. So the question really is, there's there's no way to stop that kind of innovation from happening. It can be regulated away on the main capital markets. That doesn't mean it's not going to happen somewhere else, because crypto is a global market. And so the regulators are struggling with the decision to decide, do we let this happen offshore where we can't control the risk, where we can't even see what's happening, or do we invite it into our nice, well-lit, freshly cleaned environment where we can, one, make sure that investors have the information they need to make the correct decisions, and two, keep an eye on what is happening in the markets?
My answer is yes in the short term, no in the long term. And the whole point is that like each time you have a new set of instruments, you have incomplete information in market about what the total risk of those instruments are. It creates a failure. That creates more information in the market. The market responds and understands how they should think about them. The same thing happened in the mortgage market. Collateralized debt obligations and credit default swaps weren't actually pricing the risk. The part of the reason that failed was because there wasn't actually full understanding of what the risk basis for those assets were in the first place. The same thing you can say about Luna, right? There wasn't full understanding about what the interaction between Luna and USD was going to be. But now that is known, that's going to create better products and it's going to create a safer environment. So, yes, there are going to be hiccups on the way, but long term, because of that fast failure, because of the fact that people can innovate quickly, and I think that we should push back on regulation on things like that for that particular reason, because it helps us learn quicker. I think there's still short term, probably long term, I'm bullish.
All right, thanks. One more question?
Yeah, actually, I have two questions.
Two? Two in one.
One about traditional finance. So you see like investment banks like JP Morgan, and I think BNP also joined them recently, trading intraday repo products in their own collateralized network. Is there a move from the crypto-only exchanges towards that angle as well? So taking some of their territory. That's my first question. Second question is, you have products like the perpetual futures options products. Are there any new crypto products on the horizon that we haven't heard of or that are not that popular yet?
All right. Two questions. Who want to answer either the first of the second?
Okay, well, I'll take the institutional point of view here. The first
Can you
question,
repeat the question?
Yes, the first question was, are there any new crypto products on the horizon? The answer is yes. Can't say more about that right now, but watch this space. Yes, there generally is. There's just a lot of really smart people coming up with innovative ways to present risk, which is what investors want. And the previous question was to do with, do we see the traditional institutions, the legacy financial institutions, developing crypto operations, or is it the crypto operations becoming more like legacy institutions?
Yeah, so what you see like JP Morgan and BNP right now, trade intraday repo product in their own collateralized network. So essentially utilizing blockchain technology for these products.
Yes.
And are you like incentivized, or do you have like a strategy to also move towards the traditional finance area?
It largely exists already. Genesis, for instance, is the largest crypto lender in the world. Intraday is not something that we've seen demand for yet, but repo-like products is something that we do have a lot of demand for. It's something that we do a lot of work in. It's going to happen when the institutions want it. And my personal take on this, apart from what the institutions are asking for, is that crypto is the perfect asset for intraday repo because it is a liquid bearer asset, and as such, the best type of collateral you can possibly have. It can also be programmatic. There's a lot less risk of human error. This is precisely what FTX is trying to negotiate with the CFTC right now, to change the way traditional derivatives even are cleared, to bring in some of the efficiencies in the crypto market to traditional markets. So the answer to both your questions is yes, watch this space. There's a lot of innovation coming along that space, and we already are seeing quite a lot of activity in this field.
I think as well, what you see is maybe not focused on crypto, but more on the blockchain, right? You see a lot of banks now testing out blockchain. How can they use blockchain to make processes more efficient, right? So that you can, eliminate the middle office or the back office to make it just more efficient. For example, in the derivative space, in structured products. So you take a token, you program your token with the proper payoff, so you don't have to do anything. Everything is automated, so the redemption is automated, the interest payments are automated, everything is automated on that token, right? So I think that's the major banks are mainly focusing their teams to look at that, especially in Switzerland. US is a different story with building trading desks, etc. But I think in Switzerland, that's where we are at the moment, yeah.
Last word, or I see
I
second.
can say very
Zero.
quickly, my opinion on private networks is that they're not going to succeed. And the reason they're not going to succeed is the activation energy required to get someone else to join the private network versus if you're on a public network, you're automatically compatible with others. So I think you're going to start to see institutions bringing those assets onto public ledgers, but absolutely those use cases of intraday lending is yes. And if you want a really interesting protocol that I think is going the right way for derivatives, something called Potion.finance. They're using something called the Kelly criterion to price options instead of the Black-Scholes-Merton model, and I think it's really interesting. Not investment advice.
Excellent. So we are now at the end. Thank you. Thank you very much to our panelists. Now there is a coffee break, and you can come back in this room for the crypto VC panel if you want.